Investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor. The firm only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability.
Welcome to Navigating Retirement with Rick Durkee.
And welcome into the program, ladies and gentlemen. This is Navigating Retirement, Charleston's resource for a common sense approach to planning for your financial and retirement future. If you've got questions or concerns, we always welcome those to the program and to the Coastal Financial Planning Group, of course, the sponsor of Navigating Retirement, and your host, the man with the information, the experienced, qualified professional, providing the guidance, navigating retirement. He is Rick Durkee, president and founder of the Coastal Financial Planning Group. Rick, welcome back in.
Hey, thank you to our listeners for joining us again for another edition of Navigating Retirement. Make sure you tune in every week. Make sure you go back to some of the archived editions of Navigating Retirement, several good topics at our website, cfpgroup.biz. And always remember, you can take advantage of any of this information with a quick call, 800-491-6220, and we can set up an initial 3-step review. We can do that virtually if you'd like.
And Rick, really never a bad time to update and review your plan.
Yeah, and that 3-step review will do that for you. Call us at 800-491-6220 and get your process started. It could be just a quick 15-minute initial consult. Get to know one another. It'll be virtual, be easy. You don't even have to drive in. And then if you want to go step 1, 2, and 3 through our process, we can take as long as you need to do that to develop your, as we talked about in a prior episode, defined outcome income plan. And then we'll insert the investments into that accomplish your goals.
No downside for placing that call. Get that plan put together or review and update your current plan. Give a call, 800-491-6220, 800-491-6220. No cost, no obligation, never any benefit to procrastinating. So pick up the phone and give the Coastal Financial Planning Group a call. Now, Rick, today on the program, a topic that is much more than just hot air. We're talking about inflation. and the recent announcement by the Fed that they are going to be taking a more laissez-faire, hands-off approach to letting inflation begin to creep up. Does that concern you at all?
It does. It definitely does concern me, Peter. We have to look at how that affects our income throughout retirement. And again, a 20 to 30-year span of retirement, inflation could be devastational. Knowing now that the inflation rate is going to probably be easing back up. We've had a reprieve for several years here. Historically, it's been really closer to 3% maybe. And now we might be seeing things going back up towards 2%. So we have to factor that in. I'd like to just take a little backtrack here, Peter, because oftentimes people say, well, 20 to 30 years going forward, I'm not going to worry about that right now. We'll take it a year at a time, and we'll address inflation as we go through those next 20 to 30 years. Let's go backwards 20 to 30 years. I want to take you even further back from that first. 1977, I'm dating myself. 1977, I'm in high school, and our yearbook that year was based on the Sears and Roebuck catalog. And what they did was they had all these old-timey pictures in it, and then they plugged us in kind of like Photoshop back in the 70s. They just plug us into these pictures, and they show women with umbrellas and stuff like that from like the 30s and 40s of the Sears catalog. And then they had prices of stuff, and it was like unbelievable. It was like under $1, for stuff. But fast forward now, in the 70s, if you had access to a Sears and Roebuck calendar, I keep on saying calendar, catalog, and it was from the 70s. Right now, you had it today. Do you realize how much a set of tires would be in that catalog?
Oh, man. Tires are so expensive today, but probably in comparison, next to nothing in the 70s.
Yeah, they were under $100. It was $80 for a set of 4 tires.
For all 4 tires,
for
right?
All, and now it's like 10 times that much. It's like $800 for a set of truck tires, right? So, looking at inflation from a going back in your mind standpoint, remember when gas went above $1? Okay, that was the 70s. That was the late 70s. Remember a loaf of bread and when it used to be 2 for $1. Now I'm dating myself, Peter. You're a little bit younger than I am.
Well, I remember
Yeah.
gas below $1. I think
Mhm.
back in the 80s, it dipped back to, it was
Yeah.
85 to 97 cents. And then all of a sudden
After,
it was $5 a gallon, Rick. And
yeah.
we've had a little reprieve from that. But inflation, it happens. And I think specifically in the areas that affect retirees most, inflation is more important to know and understand, right, Rick?
Yeah, it is very important to understand, and especially in today's environment with what the Fed is talking about with not interest rates, but inflation being eased, over the next, several years,
So
back into higher, inflation rate.
so a couple questions about that. You said eased.
Hmm.
I have concern that like once the cap is off the tube of toothpaste, it's hard to get it back on.
Yeah.
If they are taking a more hands-off approach to controlling it and restraining it, what's to say, Rick, that it doesn't get to 2% and then all of a sudden, before we know it and can do anything about it, it's 4%, 6%, 10%, and back in that hyperinflation kind of era of the late 70s that you're talking about?
Yeah, the Jimmy Carter years, even after that, where inflation was, crazy. And, I have people that say to me, well, in the 80s, the CDs were paying unbelievable interest rates. I mean, they were great. We were making over 11%. And then I say, well, what was inflation at that time?
Right.
It was devastating those dollars that you were making more money on. So your net, you're coming out about the same. The key that we have to think about here when we're talking about inflation is, are your income sources in retirement inflating along with inflation? Are
Yeah.
you going to be able to do that?
You have a really cool report. It's just a easy to understand one page kind of illustration, Rick, that shows a historical 3% hypothetical rate of inflation and
Mm-hmm.
what that does to our purchasing power over 25 years. Essentially, if we start out our retirement with a need for $3,000 a month to cover our expenses and have 3% inflation, by the time 24 or 25 years has passed, that need for income has doubled. Now we're up at $6,000 a month to cover those same expenses.
Right. Now, Peter, I do want to reference back to our defined outcome income planning discussion that we had recently, and people can access that again. It's the importance of having your defined income plan in writing. But in that income planning process, we factor in inflation, and we factor it in high. We factor it in about 2.5% to 3% on a consistent compounding basis all the way through retirement, because we can't leave that risk on the table. We can't have our clients coming back to us 20 years from now and saying, man, we're really, really stretching the budget here trying to make ends meet.
Right.
And we're not saving anything anymore, and we're not getting to travel anymore. Because inflation is really decimating our dollar strength.
Well, we know, Rick, that process of income planning, you've talked about it, previous editions of the program available on cfpgroup.biz. We discuss it in detail, that you are trying to help people identify what it takes to meet and exceed their standard of living, and then also identify discretionary pots of money, discretionary assets over and above the need for current income. Do you ever have the conversation with your clients that, hey, maybe we should kind of earmark some of those discretionary assets for future income to account for inflation? And hey, if inflation isn't a factor, then we always have other ways that we can use that money. But if inflation is a factor, we have planned and prepared for it.
Yeah. So you look at your income. Number one, you want to make sure that you've got increasing payments on that income. And you could do that in several ways, through either your Social Security cost of living. If you have a pension, it might have a COLA increase. If you have income from annuity payments, you want to look at the probability for success increasing if you have increasing income in retirement built in on your annuity payments. Those, are guaranteed by the strength and stability of the insurance company that issues those type of contracts. But then you've got a second pool of money that you look at that is going to cover inflation down the road. But what it has to be, that discretionary money, as you mentioned earlier, Peter, it has to be in a side pool, and it has to be invested a little bit higher risk than what a fixed income or an investment that's more safer minded would generate. It needs to be in equities, and you can get some better returns of that money, but you've got to give yourself the time horizon of maybe 5, 7, 10 years to let that money grow at higher risk, so that when you want to pull it out, it's been able to compound and keep up with and hopefully exceed what the inflation rate is, so you can supplement your income now from that pool of funds. So there's ways to do this. It's income allocation, it's planning, it's making sure that you have a defined outcome income plan in place, and then earmarking those assets for the future that are going to be able to step in and save us from some of these risks like inflation rate risk.
Well, Rick, you've got another illustration here. And by the way, we'll make links to these illustrations available on the podcast at cfpgroup.biz. But this is one about the potential cost of liquidity and lazy money. This one basically compares the low interest rate environment that we are in to what happens when inflation does occur and eats away at those dollars. And it basically is the opposite of the first scenario. What happens if we've got $100,000 in the bank earning interest at 0.1%? Now, Rick, I've seen accounts at 0.01%. So, you know, if we got account at 0.1%, actually in this environment, that's not a terrible rate. That's amazing to say. But if we do have that 100,000 earning 0.1% and inflation is at 3.5%, essentially that's cost us $96,960 in purchasing power over a 20-year period. That's amazing.
You are going backwards in that situation. You are going to find yourself in a financial meltdown if you allow that to happen. Now, I know that sounds really like this is critical. This is important. Here's the
it is right.
Well, it is. I'm trying to make sure that people understand that this isn't a I'm not trying to make light of this, nor am I trying to create some kind of I got to get that money out of the CDs right now. What you have to do is you have to educate yourself to find out what are alternatives to that safe, lazy money that you used to look at for a guaranteed interest rate that was, maybe 3-4%. Now we're looking at under 1 for sure. And so we have to get that money to work harder for us if we want it to keep up with inflation. And the lazy money alternatives right now that I'm seeing are being offered by investment banks. We offer them at the Coastal Financial Planning Group. They're called structured notes. They allow us to be able to invest in the market with less risk, but there's always risk whenever you mention the word investment. I have to be clear about that. But the defined outcome inside of the structured note gives us a higher probability for success, that we're going to see a better rate than we are getting in CDs, a significantly better rate than we're getting in CDs, with a very low amount of risk. And more than likely, these type of structured notes are going to be called after 1 year, so we don't face short-term capital gains, but they'll be called, and then you'll just have to reinvest them. But if we're talking rates at for safest structured notes somewhere in the 4 to 6 range, for a little bit more risky, you're looking at upwards of 8-9%, and I've seen them recently as high as 14%. But you got to understand, as you climb up on that return, you're going to have more risk built into that structured note. So
yeah, but at least an option and an alternative. And there are others, but this is one where, Rick, we can have a little bit more security, not all the way on the end of the spectrum with a checking or savings account or a CD, but a more conservative approach with a much more advantageous and generous interest rate or rate of return. And so we've got to just decide where we're comfortable. And again, even within that more conservative end of the spectrum, there are lots of different options available. Find out about them. Educate yourself how to keep up with inflation to maintain your purchasing power. Because, Rick, on another episode of Navigating Retirement, we talked about the 3 largest expenses of retirement. Adding up the cost, retirement can be very expensive. We talked about our largest known expense, taxes. We talked about the largest potential expense, healthcare, and the third one, the silent thief, inflation. That's why with these structured income plans, you account for those expenses and you build in pay raises throughout retirement. And I think a lot of retirees have a little bit more confidence knowing that they've addressed those big expenses and have built in a plan that includes a structure for pay raises throughout retirement.
Pay raises for your play checks. That's what we want to do in retirement, right? We want to definitely have those increases in our income. They will offset inflation risk and also give us a little bit more discretionary money so that we can have the fun that we want to in retirement without worry.
Well, final question here, Rick. The Fed, again, announced that they are going to loosen the reins on inflation. In your opinion, is this a little bit of the tail wagging the dog? I mean, with COVID, the beginning of 2020, the Secure Act, they pumped about $6 trillion into the economy. Mm-hmm. So do you think that the Fed announced this knowing that inflation's kind of inevitable? Let's go ahead and announce that's our intention anyway. Is there really any controlling it at this point?
No, there's really not, Peter. But if we look back in time, look back in March and whatnot, we had a heads up on this. Our institutional investors at the Coastal Financial Planning Group that manage a lot of the portfolios for our retail clients, they came to us with that big fear of inflation, knowing that this was going to be something that was going to come down the pipeline. So I got to say that the powers that be, the people that made these decisions, knew what was going to offset, the monies here and the money supply and whatnot was going to be inflation. And now they're easing us into it. It's, I guess, just like the pandemic itself. We didn't want to create a big fear and everybody run crazy, for the hills. Same thing with inflation here. It's inevitable. We have been holding it back for quite a while. So let's look at it. Let's address it. Let's make sure that it's something that's built into our plan and we address the risk with the issues that could pertain from inflation and make sure that we're planning for it.
Well, again, having the help, having the assistance, the guidance, the perspective of a qualified, experienced professional in crafting that written retirement income plan and implementing that plan and in monitoring that plan on an ongoing basis, that can help you have the confidence to enjoy retirement and to live each day of retirement to the fullest. That's what it's really all about. That's where the rubber meets the road. The income plan equates to confidence in living your lifestyle and maintaining that standard of living, addressing some of these risks and certainly inflation, having those pay raises into and throughout retirement. That's part of the process. You only get one shot at that ideal retirement. Rick Durkee can help you craft that plan. Pick up the phone, give a call, 800-491-6220, 800-491-6220, or visit online, cfpgroup.biz, cfpgroup.biz. Rick, a very informative conversation. Again, more than just hot air. We've got to talk about inflation when we're talking about retirement income planning.
That's right. Because if we don't, remember what that sound makes when you let the air out of a balloon, that squeaky sound, that's what's going to happen to our savings. So we got to make sure we're addressing inflation when we do our retirement income planning.
Pick up the phone, give the Coastal Financial Planning Group a call. Rick Durkee, his team, they're looking forward to hearing from you and helping you craft that plan. 800-491-6220. We'll talk to you next time on Navigating Retirement.
Catch more of Rick Durkee and Navigating Retirement by visiting cfpgroup.biz.
While we believe the information in this broadcast is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decisions. Investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.